Welcome to the Dividend Talk podcast, episode 151. How to invest €10,000 for solid dividend income. Whether you're a seasoned pro or just getting started, Dividend Talk is the place to be for insights, analysis, and unsalted advice on how to make the most of your money through dividends with our own unique European flavour. Oh, and don't forget to subscribe to our podcast and join our community on Facebook at Dividend Talk. See you on the inside. Hey, European DJI. How are you, buddy?
I'm really, really good. I mean, the weather is so lovely this week, right? So I spent quite some time with my kids also, outside biking around. So I'm fully recharged already before the weekend starts. And actually, I was really looking forward for the podcast today as well, because we haven't really spoken this week. How are you doing?
It's been quite a hectic week for me. Also, the weather here has been fantastic the last 10 days. I know Russ was over here from Canada, and I believe he thinks Ireland now has a tropical climate because for as long as he was here, the sun was incredible. It was like 20 degrees every single day. And we're still getting it. So we're enjoying it. We get it for like 2 to 3 weeks every year. So we enjoy it while we can. And I'm looking forward to my holidays and my vacation in about 2 weeks' time. So work is quite crazy. So I'm trying to tie up as much loose ends before I go away. You know how it is. It's not always possible, but I try. I always try and work extra hard coming up to my holidays so I can relax a little bit more. So I'm a little bit less active, but likewise, this podcast is what keeps me going, and it's a jam-packed show. Actually, I'm quite looking forward to this.
Yes, definitely. And then let's also just get into it straight away, because I think the big news, and I don't know if you noticed it, but this week Apple released their Vision Pro, new virtual reality or augmented reality glasses for a price tag of $3,500.
I mean, I did read that they were expecting something like 1 million units to be shipped, and then that was revised all the way down, and I think they only expect about 150K to be shipped now. I'm not surprised at that price tag. I mean, who I know they have huge brand and everybody wants to have Apple, but that's probably out of a lot of people's budgets.
Yeah, I also don't see it really for the mass at this moment. I really see it as an iPhone 1. Yeah, the first one. Also, what I understood is they released it now, so that they released the news now, but they will only launch it like next year, and this gives app developers time to start creating an app store for it, right? Here, which I think is a really good and smart strategy. I saw a review of the Vision Pro already, and it blew my mind. I mean, the cameras on there, the high-end technology that's on there, I think they are straight away, if this is all working like that, they are straight away the front runner in this space. I'm still on the sidelines about how big the virtual reality and augmented reality industry will be. I can see a lot of application for it in the industrial manner, but I still wonder how it will look like for the consumers in public. Yeah, I mean, we know that also Google Glass failed. Some of these kinds of things. I don't know if gaming is really nice on this. I'm probably also not the right target for this as a customer. Probably it's more for the younger. But then if you target more the younger generation when it comes to maybe gaming or a metaverse kind of a thing, then I also wonder about the price tag again, because this is an expensive laptop. Yeah, a really expensive laptop. And I don't know if you can do homework on it.
That's what I was thinking. The price tag takes a lot of people out of the equation. I'm not quite sure, is this what this is aimed at? Is it gaming? Is it work? Is it business? I don't know. I do know if VR from a gaming perspective, like the Oculus by Meta, is quite popular with especially the younger generation. My two kids have one each. I know they're on it every single night. All their friends are on it. I've gone on it once or twice. Usually I play the games. I'm quite a noob, so I get like all the kids telling me to get off to get off because I'm not quite good. But it's definitely from a gamer perspective, it's a younger generation, and as you said, this price tag is quite expensive. But look, I'm sure a lot more details will come out
Yeah.
over next year, and we'll start to see what this is really about. But it could be a look into the future.
Well, I'm just really impressed by Apple. I mean, I own shares in Apple, but come on, we all know what they did with these earpods or earplugs. Yeah, they just built $1 billion business out of that again. Yeah. So, and when I saw those glasses, I was blown away, and then I saw the review of it, and what high-end technology is in there. And as someone who loves technology, I'm just blown away with what they created, and just in the first launch, and that's really impressive.
Yeah, I mean, look, this is quite in the infancy of this technology and what this can do. So we won't know what the potential is until somebody takes a leap, and Apple are taking that leap now. So it's exciting times for the company, I think.
I think so, yeah, definitely. But yeah, let's get back to reality again. And what's the issue today? Because, we talk a lot about inflation, interest rates, and these kinds of things. And we all feel inflation. We notice it when we go to the supermarket. And, imagine now living in France, and you have a minister, Bruno Le Maire, and he has secured a pledge from 75 food companies, including Unilever, to cut prices on hundreds of products. Effectively, it comes down to it that they're complaining. The government literally is furious, as it's written here, that supermarket prices have hit record levels in recent months, even though the cost of many raw materials used by food producers have been declining. So they're actually at a 2-year low or something like that. I read somewhere else. So and a big reason for it is that the harvest is just generally better than expected. So they are now threatening those companies that if they don't lower supermarket prices, they will claw back their profits via special taxes. Now, only in Europe you can read this news, I believe. I think our US listeners are already flabbergasted. But what do you think when you read this?
I mean, okay, so we take it from two angles. First, if you're a French citizen that's maybe middle class to lower class, that's struggling to make ends meet, you see all these rising prices. The government are doing what they can to try and help that, and you have to commend them for that. Okay, there's not many instances where you can speak positively about the government trying to help people, and I understand that. But in a capitalist market, and as an investor, and as somebody who has Unilever, for example, you don't want their profits cut short because governments are getting involved. It sets a dangerous precedence, and we've seen it with oil companies before. We've seen this, and it looks like it's starting to happen more and more and more. Government seems to be getting involved and forcing companies to either pay tax or lower their prices. And as a shareholder, that is a huge concern because that eats into our profits, which eats into our cash flow, which eats into our dividend. And ultimately, that's what we're like. And so I'm not quite happy that Unilever have been. I mean, look, they said that they've secured a pledge, but essentially they've strong-armed these companies into doing this, or they're going to give them huge financial sanctions. So it's not like they had a choice, really.
Yeah, I've got the same thinking about you as this, and it just puts you also with your investments always wondering, like, okay, are these profits really secure? And honestly, if you let the market go, you would argue that those companies, at least some of them, would also see an opportunity to drop prices and gain market share with that, right?
Yeah.
So, but we also know that sometimes the market doesn't play out like that, and they are just enjoying all the additional profits, right? So, I mean, I leave it up to the French government. It's a democracy. People voted for it. But it's really, really interesting to read this. And yeah, I'm like you. From one hand, I do think it's good at least to help some people that otherwise might be pushed into poverty right now. But they could have done it the other way around as well, right?
Yeah, for me, sometimes it feels like we want this democracy, we want this capitalism, but governments, on the other hand, they want a little bit of going to the other side, don't they? They're trying to get a
Yeah.
balance. They don't want to be
Yeah.
completely capitalist, and it's a dangerous situation we're in. When does it stop? I don't know, but we're starting to see this trend more and more where governments are starting to get more involved, especially when companies are making big profits. And as a
Yeah.
as a consumer, and for most of the population that are not investors or not making money from this, they're probably going to applaud the government. And let's be honest, as investors, we're in the minority here. So for the majority of people, this is probably going to be good news.
Yeah. No, good. Let's see if any other country follows.
Yeah. Dividend hikes, we don't have too many of note. In fact, we have the lonely United Health Group, which hiked its dividend by a whopping 14% to 188 per share, and that ticker symbol is UNH. That's quite a big increase.
Yes, and also here, right? They can only do this when probably the healthcare premiums in the US are rising. So, but look at at the moment, I think the company doesn't look so strong. But if you look at how United Health Group has been growing over the last decade, it's quite a story as well again. So, relatively good business, I would say, and a 14% dividend hike is something I think really shareholders should be really happy with.
Yeah, awesome. Okay, we'll move on to the main topic. And this week we're going to talk about how we would invest €10,000 for solid dividend income. I'll hand it over to you. I know you have some criteria on how would you start? What would your starting point be here?
Well, first of all, why even choosing this topic? It's effectively we get often and regular questions about how to get started. Yeah, and there are people just that get some money, or they have some money on the savings account and they want to get started. So the first topic I think that we really need to ask ourselves then is, will we invest it lump sum, or will we use another approach? So lump sum means like we spend the 10K all at once, or the alternative approach, maybe dollar cost averaging, and we spread it out over time. We had also in the past Alberto from Spain here, together with his buddy on the on the podcast here, and Alberto was really making a strong case for lump sum. I was at the time for dollar cost averaging. I'm still more like that, but lately I'm also starting to lean a little bit more towards lump sum. I'm really not out on it yet. Yeah, so I believe because the first 10K is such a large amount of money, I would probably spread it out over 5 months, and then spend 2K per month on different dividend stocks, just to give myself a bit the time to learn about it as well, right? To study a little bit, to read some books. But yeah, having said that, so what is important here also is if we get this question right, 10,000 is usually just a starting point of the journey. So I also take it like that to me. So if you want to invest 10K, probably there comes like another 1,000 afterwards, another 1,000, another 1,000. So for me, it will be really important with the first 10K to put your solid foundation in. Really those 4 or 5 stocks that you can talk about on birthdays and show off what you have in your portfolio as a dividend growth investor. Yeah, so it also means that I would probably pay up a little bit more for quality than now, because I see this 10K then more as a statement. And then I will learn probably how to value companies and such, and really pay more effort to that. But paying up for quality to some extent. Yeah, I would not overpay here either. So I would still look at companies maybe not more than a 20 forward price to earnings. Anything above that is for me usually, it needs to be a really special case. I would really keep it to about approximately 60% payout ratio. It can be a bit more depending on the stock and the future growth prospects. And for this 10K, I want to see like an average yield of around 3%. So at least get $300 out of this, because it feels then it pays already a few bills for me. Like $300 can, I don't know, pay 6 months for me I don't know, some utility bills, or like more like a telephone subscription or something like that. So that's how I would look at it. And of course, I would make sure I avoid yield traps. So I would really focus here on quality. That would be my way of doing it. How about you?
Yeah, I'm interested in the first part. When you go back, you said you are leaning more towards lump sum than spreading it out. What's changing your mind there?
Oh, so I've been always like a no-brainer, dollar cost averaging. But lately I've been, I would say, thinking more about what would it mean if I would go lump sum. Because how is it? There are sometimes moments that I wonder, like, okay, this dollar cost averaging then for this 10K, am I also not just I said, no, what's the impact of it really? If I wait 3-4 months, it's not like a crash will happen 2 months later and you get everything for cheap. That usually doesn't happen. If you look at the whole stock market over the last 7-8 years that I've been investing, had mainly the COVID crash. That was the biggest one. And then the oil price crash. And for the rest, it went sideways and onwards and upwards, right?
Yeah.
So what am I really doing with these 5 months? But that's where my thoughts are going, right? I just mentioned also, like, I would still go for dollar cost averaging, like spread it out over 5 months in this case, because that's the money I feel comfortable with, 2,000 per month. Probably when I started investing, I would have probably done 10 times 1 and then use my salary on top of it and income to every month add a little bit. But now I would go now for 5 times 2, and yeah, just sharing that my thoughts about lump sum is actually kind of like, yeah, does it really make sense sometimes to dollar cost average if you don't know what the market will do? If you think about today that it looks good, then why not buy today?
Yeah. I agree with spreading it out initially in the beginning. Certainly, as a beginner investor, I always think, and it's the reason why I do dollar cost average. Well, one, because I get paid monthly and I don't have a large amount of cash on the side. But two, even if I did, we talk about this. We have a hoodie. You can't borrow conviction, but I think sometimes as a non-professional investor, we may not be as confident in our companies. That's why we diversify with 40, 50 companies. It's not concentrated in such a small portfolio. So I think it makes a little bit more sense to spread it out, and particularly if your skills in valuation are not as strong, or your skills in analyzing a balance sheet is not as strong. So you can afford to make mistakes. You can afford to kind of smooth out the bumps, so to speak.
Yeah.
If you were to hedge all your bets on 5 companies and throw it into a lump sum, it's a much bigger risk, I think, for the new investor. So I definitely would stick, for me, I would stick to spreading it out. Like you, I am looking for quality companies that have a good, strong history in paying dividends. I think that's probably one of the things I would look for when I was beginning. You don't want to take a lot of risks, but you also want to have some companies that have some room for growth as well. So you can look at huge, large caps that you have, and I know you'll mention some of them, but sometimes there's not much room for capital appreciation there. It will happen over time, but maybe at a slower rate. So I'll be trying to look at some companies that have a little bit of room for growth, and you'll see that in some of the companies that I've picked as well.
Well, let us not wait any longer, the listeners, Derek. What companies are you talking about?
So that one particular company would be VICI, which is a real estate investment trust. I would also pick companies in areas that either I'm interested in or that I know pretty well. And VICI interests me because of Las Vegas. I've made no secret of my love of that place, and the fact that they own pretty much that whole strip, and that's a money-making machine. I can't see it going out of business anytime soon. They do have other places, not just in Las Vegas, scattered around the US and Canada, but I think they got really strong growth prospects there. I like the business model. You get a really good yield at 4.74%, and also now they've only raised the dividend for the last 4 years because it's a relatively new company, but they've raised it every year at an average growth rate of around 9%. I don't expect that growth rate forever, but certainly over the next 2 to 3 years, I can see that sticking. So that would be one company where I can't really say that the dividend history is there, but I can say the growth is there. I think they have a good future. They have a good foundation, and they've certainly given us a good start with the 9% dividend growth rate.
Okay, so the first purchase is VICI
Yep.
to nurture your gambling spirit.
Yes.
What would
Yes.
be the second one then?
My second one will be closer to home. So it's a Irish-owned company, CRH. We know them as Roadstone over here in Ireland. What surprised me about this company is I knew Roadstone was a big company, but what I did not realize is that most of their operations actually take place in the United States. They're a much bigger company than I first gave them credit for. They have nearly 2.5 decades of a dividend history, which is quite good, particularly for an Irish company. 12% 5-year dividend growth rate and 11% 5-year growth rate and a 2.6% starting yield. I do like these types of companies. I think they have good future. I do know they're heavily involved in projects such as rebuilding Ukraine. They supply all the raw materials, like concrete and all these kind of things. So there's plenty of room for growth there. They're also, which I find interesting, they're moving from the London Stock Exchange, which Irish companies inherently sit on, to the US, to the United States, to the New York Stock Exchange. And I think that's a good move. While doing that, they will transfer to the American way of doing things by reporting quarterly, probably paying dividends quarterly. And I think that's probably a good boost. And if you look at their price in terms of where they are in sterling and dollars, there's a slight gap there, and they look quite undervalued actually on the New York Stock Exchange. So it's that's probably one I go. So a construction company from Ireland.
Cool. So gambling, Ireland.
Yeah, we keep going. So next one I would look at is T. Rowe Price. And why would I look at them? So first of all, I think having a clean balance sheet is super, super important. They have one of the cleanest balance sheets that we've seen, bar someone like Microsoft, which is AAA rated, or Johnson & Johnson, which is also AAA rated. These guys have a really good balance sheet, very little debt, 36 years of dividend growth, which scratches my itch. I need to have someone that's paying out for an awful long time. They've 3 decades, nearly 4, and they give you a 4.2% dividend yield and a 14% dividend growth rate. So I think they qualify as a quality company.
I would say so, yeah.
Moving on to that, what else do I like? I like high yielders. I cannot deny I like high yielders. And who better than the company that is building a better tomorrow? British American Tobacco, ticker symbol on the New York Stock Exchange is BTI. Ticker symbol on the London Stock Exchange is BAT. What can I say? I think I have quite a bit of these in my portfolio, them and Altria. We spoke about them quite a bit on this show. We know that we feel like they're better managed. They're moving into this non-combustible space a lot quicker, a lot better than some of their peers. They are being hammered a lot recently, giving them a whopping 8.19% dividend yield. And obviously then they have a decent 16% 5-year dividend growth rate as well. So I think
Nice.
I think I'd like to have a high yielder on my account just to see that extra little bit of growth. I know you're aiming for around 300, but I'd like to see like an average yield of 4% in my portfolio because I'm greedy.
No, that's good. That's good. And I think addictions are often really good business models when it comes for dividend paying companies, right?
Yeah. And it's something that you can easily understand, right? As a person, you don't have to. So maybe understanding VICI and their business model might be a little bit harder, but everybody can understand what British American Tobacco do. You can look at their products, you can go down to a shop, and you can see them, and you can get a sense of what's happening. So I always find that's easy.
And you can observe people buying them.
Yes, exactly. Yeah. And then my last one is a monthly dividend payer, and it's not Realty Income. And before you say it, so it's a company I've mentioned on this podcast before, and that is Cognet Communication Holdings, ticker symbol CCOI. They're a little bit different than the likes of Verizon and AT&T is in their very niche down. They've got concentric customers, they're like business customers, and they offer them just literally like a direct line fiber optic cable, and they give them super fast broadband. Because of that, they're able to obviously charge at a premium, and their growth rate, particularly the dividend growth rate, is incredible. They actually have raised their dividend. I don't have the number off the top of my head, but I think it's like 100 quarters in a row, or something like that. Quite a bit. So every quarter they're raising their dividend. They have a 12.5% dividend growth rate, which is acceptable for me, and a 5.86% dividend yield. It's a really, really nice company. I honestly, I think you should check it out. Just be careful when you look at the numbers. They do trade at a high PE ratio, which kind of puts you off. But I think it's a really nice business model. So overall, that gives me an average dividend yield of 5.12%. So I'm earning €512 for every 10,000 I invest.
Nice one. And you can do quite a good party from that one.
Yeah, cool. Yeah.
Cool. So, I have a little bit of a different approach than you. And actually, your reasoning is quite interesting there, because it's like gambling, tobacco, how is it? Communication, Ireland. So I get that. So I have a little bit similar kind of thinking. Like, let's take stocks from different sectors as an example. So I didn't want to have two stocks from the same sector, although I've been cheating on one of those. But I'm actually already straight away, as a first one, I will buy Starbucks. Yeah, and I'm not too big of a fan of the balance sheet. You called out the balance sheet of T. Rowe Price. I believe Starbucks' balance sheet is not the best. But it's mainly because I know the product so well. I see Starbucks on the same line as Nike, Coca-Cola. From a brand power point of view, I still think they have a lot of room to grow over the years. Well managed every time when the former CEO steps in. We'll see how that goes. But, they have a 2.14% yield, so it's below the 3% yield, but I have other stocks to average it up. A 12% 5-year dividend CAGR, 12 years of growth, and a payout ratio currently of 65%. Starbucks for me will be really one that I really can resonate with as a consumer, a product that I know a lot about, or can really familiarize. I see the lines everywhere. Again, it's unbelievable here in Poland what people are paying for coffee from Starbucks. I don't even get it where they get the money from, but the lines are there, and people are proud walking with a Starbucks coffee around over the street. So the stickiness is really, really strong there. The second one, then, I would go into the information technology sector, and I would go for Texas Instruments, because I believe that this is just a powerhouse, really a strong compounder with, an 11% annual growth over the last, 12, 20 or 30 years.
It's incredible.
Insane. You can get it currently at a 2.9% yield, 15% 5-year compounded annual growth rate, 70 years of growth, and the payout at 53%. But I wouldn't pay full 2,000 for it. I would only buy 1,675, let's say, euro in shares, because the other one, I will at least buy one share in Microsoft. They are heavily overvalued, of course, more than a 20 PE. They had a strong run up lately after this whole artificial intelligence hype kicked in again. But just as an admiration, because many people see Microsoft as a growth stock. For me, it's also a dividend growth stock. They have been growing the dividend for 18 years now. They payout ratio is 29%, and they have a 10% 5-year CAGR. Of course, a yield only of 0.85%. So that's not going to get you far. But if you mix it in with Texas Instruments, it looks much better, and at least you can say that you own a part of Microsoft. Yeah, it also needs to be a bit of fun. So this is where I was cheating on choosing two stocks for this sector. The third one has to be Johnson & Johnson. For me, as in the healthcare space, I think, even though I often say about the pipeline that I believe it can be a bit stronger, I still believe it's just one of the best managed companies in the world. And it's if you ask anyone in the dividend growth community about the most iconic dividend growth stock, I think more than a majority will call out Johnson and Johnson, and I think it belongs really in many portfolios as an anchor to a person's dividend growth portfolio. Currently, you can get it actually at a 3% yield, which is really nice, and I believe they are getting a dividend hike anytime soon, right?
Yeah, it should be.
It's up for one of these weeks. You get it at a 6% clockwork 5-year dividend growth rate, 60 years of growth, and a payout ratio of 45% at the moment in time. Then I would go for a consumer staple. So Starbucks was a consumer discretionary. Then I would go for consumer staple, and it has to be Ahold. It's a company that I know. I know the supermarket chains. I don't know them so well in the US, but US is also really doing well there. You can get them currently at a 3.6% yield, 10% 5-year CAGR, which is really a lot for a company like Ahold. They do, I believe, a 1 billion buyback per year, which equates to approximately 2 to 3% as well. So that's also part of the yield that you can consider. And they currently pay out 41% of their earnings and dividends. And the last one, I would also go for financial, but I thought everyone needs a life insurance or an insurance. Everyone needs this. This is a business that will continue to sell products, right? So I just thought I need to go to the biggest in the world, and that's Allianz, German Allianz. You can currently get it for a 5.5% yield. They have a 5% 5-year CAGR, so it makes it 10.5. Chowder rule, not 12, but good enough. 14 years of growth and a payout ratio of 56%. This together would mean a 3.3% average dividend yield based on the 10,000 invested. Like I mentioned, maybe not all stocks are cheap, but it's more like just to put an anchor in my portfolio around some high quality dividend growth stocks.
Yeah, you have to say that yours is jam-packed with high quality there. Texas Instruments, Microsoft, Johnson Johnson, Allianz, they're all really high quality, and everybody will know them. Ahold, we know it's high quality. Maybe not so much people outside of Europe might know that company. And obviously Starbucks is the darling. I just don't understand Starbucks as a consumer in terms of it's always packed. As an investor, I can see the appeal. For as long as those stores are packed, keep buying up shares. It makes complete sense. But yeah, that's a really strong portfolio. There's not one company I would change. I would have to say.
Good. So this effectively concludes how we would invest 10K, right? If we would have 10K now. So I think to sum it up, we will both spread it out. In my case, 5 months, probably use something similar.
Yeah.
Also 5 stocks. That's also interesting, right? We didn't say 10 or something like that. 10 for me, you build that later up afterwards, right? Once you get your salary again and from your savings, you can start adding number 6, 7, 8 and take the time to learn. Yeah, so I hope people enjoyed this section of it and this topic, because this was the main topic of the show, and we have really lots of questions now. So I think 30 or something like that, some really interesting ones. So I would say let's get started with those, Eric.
Let's get started, but I do have one request for the community. I would like them to post, out of them 10 tickers on Facebook, which 5 would they pick from the two? That would be interesting to see. They'd probably pick all 5 of yours, but I would like to see.
What we can do is we'll put a poll. We will put a poll on our Facebook group, and then people can vote.
Yeah, that'd be cool. Okay, listeners' questions. As you said, we've got quite some here, so we'll race through them, but we'll try and answer as much as we can. Simon has asked us, if you are wanting to impress your father-in-law with your best dividend growth stock pick to date, which one would it be and why?
So it's maybe not let's say the best dividend growth stock, although they cut the dividend in 2020, that would be Shell. And why? The dividends almost pay for 70% of the fuel that I personally consume in a single year. And a father-in-law, at least father-in-laws that I know, they always look at fuel prices and such, because it's that generation. They're like around the retirement age. They always complain about fuel prices. So then I can just show off saying like, hey, my Shell investment pays almost all my fuel in the entire year. And, you know, every dividend hike will make it only nicer and keeps me in sync with rising gas prices at the pump as well. I think that will impress them the most.
Yeah.
And then maybe also spark the conversation about the power of dividend investing, because it makes it so close to their wallet.
Yeah, I would obviously pick Shell as well, and I would make my father-in-law listen to the episodes where we were recommending Shell when everybody was saying oil is dead, it's going nowhere.
Yes, definitely.
I think that would impress him more, because it shows I have the cojones to go against the tide, and he can respect that. That's what I would do. Massam has asked us, thank you for allowing me to join your group. His question is, he gathers from the podcast that you keep investment money aside every month, which is what he's trying to do as well. But however, he struggles to utilize all of his money every single month. So his question is, do you remain 100% invested, and how do you do that consistently month after month?
So I think the underlying issue that he is bringing up here, that I struggle sometimes with as well, is inspiration. Yeah, because what he also mentioned is that he places limit orders, right, for stocks he wants to own. And what if the limit orders are not triggered? I do the same. Well, it's really simple. By the end of the month, if my cash is still on my balance in the broker, I will just look at one of my stocks in my portfolio that I own already, and ones that I feel are of decent to high quality enough, I will just look at some of the yields and think like, okay, this is more like 3 to 4% yield or even more. I still don't have a full position, and I will add there just at that moment in time. It's also sometimes good because it avoids price anchoring as well in my investment strategy. And also, you don't always need to wait for something that is fully undervalued. If you're already convinced about the stock, you're just buying dividend income at that moment in time. It's for me really important to do this every month, Mossam, because my learning was in the past that I kept money on the side and then started piling up, waiting for a crash or something like that. And then you're just, you know, all the time maybe starting to, okay, let's say you had I said a limit order on $100, and then the price goes to 110. Yeah, well, it was trading at 105. Okay, and then you start upping it to 105, but then you think like, oh, last month I could have bought it for 105. That's what happened to me in my early years in like 2014, 2015, and I've underinvested in that time. So, and then I had to make up for that, but then you have already the 2 years lost of dividend income opportunities you had then, because good companies, they continue to grow typically, and the share price of tomorrow might never be the same anymore as what it was yesterday trading for. Sometimes they just fly away from your hands.
Yep. Good stuff. Stanley has asked us, how do you work out the dividend yield of the whole portfolio?
I calculate the total projected annual dividend income. So that's like the absolute income of all the stocks and dividends that I should get. So let's say if you own 20 shares of this times $1 or €1 is 20 euro, you go to the next row with your next holding, and then that divided by the entire portfolio value.
Makes sense. John has asked us, how do you account for the amount an individual invests to work out your performance and growth? For example, he only counts the money he pays into his account, while he had a discussion with his friend who accounts for this, but also the money that he reinvests into his portfolio. So for me, I would only count the money that I deposit into the account. I think the money that you reinvest is money that you've earned from your investments, but I really, honestly, I only check my performance against what I deposit. So I'm quite similar to you, John. Yeah. Morris has asked us, at what interest rate would you consider putting money on your savings account instead of investing it?
8%, because that's kind of what I expect from my portfolio as a return over time. And, you know, in my case, it's probably like, I don't know, a 3% dividend yield plus 5%, 6% dividend growth. Then I would probably put some money on my savings account, but only if I feel that the stock market is really overvalued at that time, or then there's really nothing attractive to find. Then I could consider it.
Yeah, it's a tough one. I would want maybe 8 to 10%, but I'm always skeptical of leaving lots of money in the banks because they can hold on to it, and they have held on to it in certain cases. So, yeah, probably I would want a high interest rate. Paolo has asked us, I would like to start encouraging my daughter by showing her the advantages of investing and opening an account. But in Portugal, it is not allowed to open brokerage accounts before the age of 18. How is it in your countries, or how do you do it? We have a similar problem here in Ireland. I suppose we are European, so it's probably the same across similar. But what we do is we have an account set up in my wife's name, but it's just my kids' money. And then we get to 18, we'll have to worry about the tax implications and how we'll manage to transfer it over. But at the moment, it's in my wife's name, and my kids manage it on their own.
Yeah, same for me as well. Exactly same process.
Yeah, I don't recommend doing that. Maybe talk to a tax advisor, because there's obviously going to be some tax disadvantages for that. But I'm just sharing what I do. Just to be clear on that. Martine has asked us, for some valuation models, you fill in the earnings per share growth. But what if I want to calculate the fair value of Johnson & Johnson and Target? They show the last 5 years as negative earnings per share growth.
Yeah. So Martijn, I don't know what kind of valuation model you're talking about, but if you would do something like a discounted cash flow model and you use earnings per share, you can do that, right? I would just use the growth expectations going forward, not backwards. If it's something else, I really can't. Then I can't really help you there. Ping me on Twitter or on Facebook and clarify a bit more. But I would just take the earnings expectations. If you don't know what they are, you can look at the quarterly earnings report. Usually the management has their own guidance there. Or you can look at analyst expectations. You find that on the different websites like Seeking Alpha and such. You can see there what they are expecting, and derive the percentage growth from there. Or if you have a good feeling for what it is, you can of course plug in your own number.
Nice. Centrino has asked us, on Trading 212, what's your opinion about the share lending feature, and are there risks for us who own these shares? Personally, lots of brokers offer this type of feature, but you get paid to lend out your shares, I take it. And some people think of this as earning easy money, but I always learn there's no such thing as a free lunch. So there's definitely risks associated with it. I don't know what the risks are. I don't participate in it, anything like that. I try and stay away from it. I just want a simple life. Buy my shares, keep my shares, own my shares, and stay away from all the fancy stuff. So I personally would not be interested in lending out my shares to anybody. Yeah. David, do you own any ETFs? And if so, which ones?
So in my portfolio, not at all. I do have a pension scheme account where there are some in there. I couldn't even tell you what they are called because it's all provided via there. I had to just select 3 out of 10 or something like that. I just know that they have exuberant fees. I'm not happy with that, but yeah, it is how it works via my employer. But no, I don't see a reason for having ETFs because I think my dividend portfolio is the ETF that fits my strategy the best.
I live in Ireland and we have this stupid deemed disposal rule. So until that is gone, I will never own any ETFs. Russ, our good friend Russ, has asked us if you could recommend one set it and forget it European dividend stock to an American to look into, which one would it be?
I mentioned it today already. It will be Ahold with ticker symbol AD. I know I'm bored. I'm getting boring there. But for instance, I find that one, I have more confidence in that company at the moment than Unilever, as an example. Maybe my thoughts will change in a year from now. Ahold had, of course, a major fraud in the early 2000s. I think they learned from that. They are over that. It's 20 years ago. So it's quite some time, right, for management to prove. And I still think they have enough growth potential ahead of them here. I can imagine that maybe one time they will spin off their US business or bol.com. Maybe that will put the dividend a little bit at risk, but I would expect that with a spin-off and such, the other companies would also pay dividends. And maybe it would be then a case of, what was it, Abbott Laboratories and AbbVie, where it in the end still continues to spit out a lot of dividend growth over time and wealth. So I would go for Ahold.
I would probably stick more with the likes of luxury brands like L'Oreal or LVMH as well.
Yeah.
For set it and forget it, I think you can't go wrong with those types of companies. Russ has also asked me a question, I assume. Why are there no share curtains in Ireland in Irish hotels? There is, but they're the really cheap hotels. When you go to a decent hotel, which I'm sure he's in, we have shower doors. Well, I assume he's had shower doors. Most hotels I go to have shower doors.
I've never, I can't remember having seen shower curtains in a hotel.
Yeah, like it's a really, that would be maybe 1-star, 2-star hotel.
Yeah, but why would you need one?
I don't know, privacy. I don't know.
Privacy for who? For your partner?
For yourself. You don't want to look in the mirror behind you when you're showering. I don't know, but generally it's a shower door that we have over here.
Yeah, so, yeah, exactly.
I don't know. Is it different? Is it different in America?
I can't imagine. I can't remember. But I've been several times in America, but I can't remember shower curtains in there.
No, I was in Rochester a couple of weeks ago, and it was definitely a shower door as well. It wasn't curtains. Yeah. So. Maybe okay. Canada. Maybe Canada is different. I haven't been to Canada.
Okay.
I don't know.
Well, I can tell you this is the only investing podcast where people are talking about shower curtains.
We have a question from Jerry, who has asked us, any interest in Italian dividend growth stocks, since he will be listening to the podcast in the lovely Sardinia.
Oh, he's making us jealous here. I would love to be there. So, Jerry, I would say buy a Campari and just enjoy it and know that it has 22 years of dividend growth or remain. It has a payout ratio of around 13 or 14%, if I'm correct. Unfortunately, it only pays 0.5% in dividend yield at the moment, because I think they pay 6 cents on a share price of 12 euros something. But I think that's probably one of the best dividend growth stocks, just unfortunate low yield. And then the second one I would say is the red car, right? The Ferrari. I think it's also a nice one. And if you really want to have a bit of a higher yielder, I believe Eni, the oil and gas major.
Enel, yeah, the utility Enel. Yeah, I was going to mention those ones. That's probably, if you want dividend yield, that's probably the best one to look at. But Ferrari, ticker symbol RACE, is my favorite of the three. So Caspar has asked us, which shares have you acquired, sold in recent months? I haven't sold anything. I've been buying up NN Group, VICI, Legal & General, Johnson & Johnson, probably those 4 recently. Yeah, I think that's it. And there was also Medical Trust as well that I was buying.
Okay, so MPW, this because it yields like 12-13% right now.
Yeah.
Yeah, you feel comfortable with that one?
MPW.
Yeah. Or it's another one that you mentioned. MPW, yeah.
No, it's not that medical. It's GMRE. I spoke about them on my blog. Yeah.
Okay. So I bought some Target, Johnson & Johnson, CBIS Nordic Real Estate, and T. Rowe Price. And yeah, there's another one, but I'm writing a blog post, so people will find out there.
Good. Nakama has asked us, what do you think about luxury stocks in Europe? Some say they are equivalent to the US tech stocks. I mentioned earlier LVMH, L'Oreal, for example. Yeah, I mean, there's some really good luxury brands we speak about loads of them on the show. My problem is they always seem overvalued. They never seem to be because they keep growing, growing, and growing. I would love to own some of them. I just have a mental block with buying them at such high PE ratios.
Exactly the same here.
Okay, so we have a couple more questions. These will involve lots of different tickers. So Jason Hurley has asked us, how's your Walgreens position looking? Quite shit. It's in the red, but I think you asked me about this last week or the week before, and I'm happy just to hold them. I'm not adding to them. I'm not doing anything. He's also asked me my thoughts on the newest opioid payout. I think they've had to pay out 500 million. We knew this was happening. It happened to CVS, Walmart, and a couple of other companies as well. So I think that's kind of old news. The money's not life-changing. It was expected. I just hope that nearly puts an end to it now. But in terms of my position, it's in the red. Even with dividends, it's in the red. So I'm just going to let it sit there and see what happens. I still think, I mean, look, they had this Village MD, and I still think it's a good idea. Walgreens, as we know, is all over the US, so they're not going out of business anytime soon. I think the dividend is reasonably safe, but I don't know if the growth will still be there. So I'm going to hang on until such a time they cut the dividend. Bass has asked us thoughts on valuation of Enbridge and Total Energies.
Yeah, and then by the way, we'll put all the tickers again in the show notes, right, for people that are looking at the tickers.
Yeah.
So Enbridge, ENB, I've been looking into them several times because I think they have a 7.3% dividend yield or something like that, and always I shy away from them. I believe they had the last 1 or 2 years really small token increases, if I'm correct. But there's a person that can better answer this question, I would say, because the dividend guy just sold all his Enbridge shares, and he shared this in a YouTube video, and I will put the link in the description of this podcast. So check out the dividend guy video about why he sold it, and I think he's a very clever guy, so I would definitely take his thoughts at face value.
Yeah, I would probably take his thoughts on Enbridge, definitely over mine anyway. So check that out.
And then Total Energies, I take a symbol TTE. They are now around 5.4% yield. I think they are fairly valued. I believe the whole oil and gas industry is at a proper valuation. The oil price went a bit down again over the last few months, right? I think it's good. It was a bit too hot for my liking. Cash flow will be, of course, a little bit less, so we will see that also turning back into the share price. But I think if you can get Total Energies for 5.4% yield, I think it's decent. It's not. You can get it probably you can probably get it cheaper at a certain moment in the future, but if you want the yield now, then I think it's safe as well.
Dividend in Guts or Schrift. I don't know how my pronunciation of that
Dividend in Gutschrift, I think.
Yeah. So I was completely out, but he has asked us a question again on utilities, which is quite popular today. Do you have any views on UGI Corporation? Ticker symbol UGI.
So I don't really know the company, but Jeremy, who was on from Dividend Stockpile, who was on the podcast, I think 2 or 3 shows ago, just wrote a post about it, and he posted also on our Facebook group, Dividend Talk, right? So also here, I will put the link in the description. He did a company dive on UGI. Generally, if you look at it from a screener point of view, right, they pay a 5.3% yield, a payout ratio of 50%, and a 5-year growth rate of 7.5%, which gives it a really high Chowder score of, around 13, and a dividend growth track record of 35 years. So I believe that, I said it meets kind of all the screening criteria. Yeah, I would say have a look at the article that Jeremy wrote. It was very insightful, and yeah, link is in the description.
Yeah, Jeremy's quite clever, so I would stick to his analysis on this as well. It's quite good. Davide has asked us, what is, in your opinion, the best utility stock for dividend investing? We mentioned actually an Italian one ENEL earlier, which 8.1% yield. We also have talked about Iberdrola on this show as well. I know we had the two guys on talking about that before. But personally, I like Enegas, and the reason why I like Enegas is they have a dividend floor that you know your dividend is safe. I think it's for the next 2 or 3 years, and I really like that. So I own them, I'm long them, so it's probably that reason as well. But I do like that the dividend is quite predictable for the next couple of years.
Yes, and I think gas is also, I would say, the transitory energy source, which I think will still do well. Of course, we hear a lot from the Spanish community about how much can you trust the government there. Well, we spoke about France today as well. I think it's a fact of life for us as investing in Europe.
Perfect. Steve has asked us our thoughts on McDonald's and Tyson Foods.
So I think McDonald's is just heavily overvalued. 31 times price to earnings for a cheeseburger company is too much for me. It's really too much. So yeah, not even going further. Of course, the business wise, it's brilliant, right? The golden M, it's brilliant, but at the right price. Tyson Foods shares are currently at a 5-year low, 3.8% forward yield, also a high forward PE at 31, but that's really because of the really low earnings expectations going forward. The reason for that is, if you looked at last earnings report, they're just not able to pass on the inflation to the customer. The cost of goods sold, I believe, in chicken and beef has risen really significantly, and they were not able to pass it on from what I understood. So, you know, from the other end, screening criteria, 43% payout ratio, 11% growth rate, 11 years of dividend growth. Not bad for a 3.8% yield, but, you know, I don't know, might sound also a little bit like a value trap. I would really need to study Tyson Foods a little bit more to understand that.
Yeah, it seems quite popular. We've been asked about this last week as well. So lots of people are interested in that. So do your own research on that. I'm not too sure on the company, so I'll take your word on it. Salim has asked us our thoughts on Vonovia. The price seems to have settled. We spoke about this recently on the podcast. Vonovia are in the too hard category, and we know that there's lots of political pressure in Germany. I think we had heard someone on the podcast talking about that before, I believe. But look, there's lots of different aspects over there that I don't understand. I don't live in Germany. I'm too far away from it. Similar to Castellum in Sweden, I don't like investing in them when I'm too far, particularly in Europe, as the landscape for real estate investment trusts is different, and it's a lot different to the way the US run there. So I put that into too hard. I prefer to maybe get an ETF, or I did mention I had a CEF that I was investing in that also invests in all these types of companies. So I would probably stick to that route rather than going individual real estate investment trusts in Europe.
Good.
Daniel, just ask Daniel's one. It's Anders has asked us about Novo Nordisk. What's your thoughts on the UK government ordering a huge amount of Wegovy to distribute through a trial conducted by the NHS in an effort to combat the rising obesity epidemic in the UK?
I mean, this is all bullish, right, for a stock like Novo Nordisk. Also, the celebrities buying up massively Wegovy in California and such, right? It's really, really bullish. I can't escape from the thought that I have in my mind, right? We have expression in the Netherlands, and it goes a little bit like this. It's like wiping the floor while the water is still running. And this is kind of the thought that I get, like, okay, why does the UK maybe not invest in prevention more, right? In the sense of just like put a large sugar tax, or and use that tax, for instance, to lower the tax on healthy food, so that for the lower income class, and assuming that we see more diabetes there, right? Maybe I'm biased, might be my mistake, but that is more affordable for them to have healthy foods. I think that could be a more powerful one, in my opinion.
Yeah, I mean, it's as you said, it's bullish on Novo Nordisk. We spoke about this before, but I agree with you. Maybe the government should take different precautions. But look, if you're a shareholder of Novo Nordisk, this is good news for you. I'm sure the cash is going to be rolling in, and that share price will keep going up. But yeah, it's a strange one. It's a strange one indeed. Robert has asked us our thoughts on Swiss RE. He knows you like your insurance companies, but not from Switzerland.
That's true. However, let's assume not the dividend tax. 6.5% yield, growing their dividend since the great financial recession in 2009 when they had to cut it. Actually, for the dividend fanboys, and this year they switched from Swiss francs to US dollars, and it looks like they increased the dividend. But actually, if you take the how is it the currency currency exchange into consideration, they did actually small dividend cut. I don't know why they did that, but I think it's actually quite a good business, I would say. In Switzerland, anyway, there's a culture also of insurance. I like that also. One of their what they call capital management priorities is to grow their regular dividend with long-term earnings and at a minimum maintain it. So there's also here progressive dividend policy. So I think it's an interesting one. And if you live, for instance, Switzerland, and I would definitely consider this one for further research then.
Nice. Hans has asked us about ticker symbol IIPR, innovative industrial property stock. Do we own any? To him, it screams like it's a yield trap. Personally, I don't own anything. Remember, we had Wolf of Harcourt Street on this podcast. It seems like an eternity ago. It was back actually maybe season 1 in our first year. He was always talking to us, particularly me, about this company. I always said I put on my watch list. I never did. I suppose the USP, their unique selling point, was always around their offering buildings to companies that are nurturing this cannabis and medical cannabis, because the legislation was passed in the United States. It turns out that there seems to be a bit of liquidity crisis in those types of companies, and there's talks and rumors that IIPR are not receiving their full rent, which is probably why you're seeing a forward yield of 10%, because the share price has plummeted. It's a real hard one for me because I don't understand that world at all. I don't know how big that can be. It feels to me it was a little bit like on Twitter we had all these electric vehicles. Remember, we had NIO, we had Tesla, we had Solo, we had Ride, and that was they were the darling stocks. And then we had cannabis as the darling stocks for a while. And they all kind of shut down. It is expected that industry is going to reach 7.1 billion in sales by 2030, but how much of that can IIPR take over? So I don't know. I don't know an awful lot about the company. Subconsciously, I stayed away from them for a reason. They had super high dividend growth. That's now going to be non-existent, I'd imagine, if they are not getting rent and they're struggling to make money that way. So not for me. I'm afraid. I'm not too sure on the growth prospects, but I think the Wolf of Harcourt Street did an article, or he's still bullish on him. So if he has one, I might ping him. I'll try and post a link to that if you want to read. John has asked us our opinion about Nike's recent price drop.
It went from $120 to $100 right now over the last few weeks, or maybe 2-3 months. It's still too far away. A 30 PE is still for me a bit too expensive for Nike. Although what he says, 40% payout ratio, strong balance sheet, 11% dividend growth rate. It's the dividend yield. What is it, 1.3% or something like that?
Yeah.
So it's not attractive enough for me. I would need to see the price drop further to be really interested.
Yeah, I need to see that price drop to what it was on March 16th, 2020, which was around $67. In around the $70 range, I'd definitely be interested.
Yeah.
Above 100, I'm not there.
But great business. A clear example of a great business, but not a good investment at the moment.
Yeah. The last name we have, you might pronounce this name because I haven't.
I also don't know. That's the beauty of Europe, but let me try. Uddelningskontrolleren.
Yeah, you definitely made a better effort than I did. He's asked us on our thoughts about a Finnish company called KESKOB.
Yeah, and this one is really nice because we had to look it up. So maybe for our listeners, KESKOB is a Finnish trading company. They operate in grocery trade, building and technical trade, and car trade. And they have around 1,800 stores engaged in these operations in Finland, Sweden, Norway, Estonia, Latvia, Lithuania, and Poland. So that was really, really nice for me to see. They grew the dividend since 2016. They had a small cut before. They did a share split as well. So for me to really calculate now, the 5-year CAGR was a bit hard. I need to first calculate back all the dividends. But what I also like is that their dividend policy in the long term is to distribute a steadily growing dividend. So, of course, they connected to the payout from earnings to share around 60 to 100%. But yeah, really interesting one. And it feels like one that I want to study a little bit more. So I'll put this ticker symbol also in the show notes for the podcast. But Uddelningskontrolleren, thanks for bringing this one up. I like so far what I see. It kind of hits my screening criteria. So I'm definitely going to have a look at it a bit deeper. But I cannot say anything more meaningful because it's for me like a 5-minute maximum scan that I did on the company here. And I don't want to act like I know anything else about it.
Understandable. Yeah, no, it definitely seems like an interesting company. I think it's the second Finnish company we've been notified about in the last little while. But I was just looking at their dividend growth rate, and it seems quite impressive, particularly on Kaifin. It has 14% over the last 5 years. So it looks like it could be a decent company. With that is the last question of the show. We did well. There was lots of questions there. I hope we answered them all. I hope we didn't miss any, but I hope we answered them all sufficiently as well. So thanks to the community. Sometimes we get one or two, sometimes we get loads, but we do really love the questions. It does give us lots of different things to think about. So keep sending them in to us.
Thank you, everyone, and have a great week ahead.
Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.